They want your eyes on silver because silver is loud, silver is crowded, silver is where everybody's looking. But the real pressure cooker right now is the metal nobody is watching, platinum. And here's the part that should make you sit up. Platinum is already moving like a market that can't find supply. As we speak, platinum is trading around the low to mid $2,300 per ounce, and it's ripping higher on the year. That's not random. That's not just another metal. That's a warning flare, because platinum is not a story about hype. It's a story about deficits. It's a story about concentrated supply. It's a story about industrial addiction, and it's a story about a small market that can move violently when the door gets crowded. So if you came here asking, is there a metal that can go vertical before everyone else notices? Yes, and it's sitting right in front of you. In this video, I'm going to do 3 things. Prove the platinum deficit is real and structural, show you why the next squeeze can be faster than silver because the market is thinner, give you the battle plan, what matters, what doesn't, and what signals you watch so you're not late. This is not a get-rich-quick video, this is a positioning video. Because when a market is short, the move doesn't ask permission. Let's get into it. Here's the trap in 2026. People think the only metal story is silver. And I understand why. Silver has the headlines. Silver has the squeeze narrative. Silver has the paper versus physical drama. But here's what markets do. They punish the crowded trade, and they reward the ignored one. So when everyone is screaming, silver, 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 I start asking, what's the metal with a real deficit, real industrial demand, tight supply, but no crowd? That's platinum. Platinum is the quieter room in the same burning building. And right now, the building is starting to creak. Platinum is a strategic industrial metal disguised as a precious metal. That's the whole game. It has the psychology of a precious metal, scarcity, store of value behavior, safety flows. But it has the consumption pattern of an industrial metal. Factories need it and they don't care about your chart. And that combo is explosive. Why platinum can move faster than silver? You want the simplest reason platinum can go vertical. The market is smaller, the liquidity is thinner, the supply is more concentrated, and the deficit math is more fragile. Silver is bigger, deeper, more heavily traded. Platinum is like a narrow bridge. When everyone tries to cross the bridge at once, the bridge doesn't politely handle the traffic, it buckles and the price jumps until demand is destroyed or supply is coaxed out. That's how commodity squeezes end. Let's talk numbers, because this is where people get uncomfortable. The World Platinum Investment Council has been tracking persistent deficits, and Reuters has repeatedly highlighted how supply weakness deepens the shortfall. One of the cleanest signals in any commodity market is this. Are above-ground inventories shrinking? Because if they are, you are burning the furniture to heat the house. And platinum has been doing exactly that, running down inventories. Reuters. Now, listen carefully. Even when forecasts wobble between deficit and tiny surplus in a given year, the bigger reality is this. If you've been drawing inventories down year after year, you don't magically get safe again because one spreadsheet says plus 20K ounces. That's not a rebuild, that's a rounding error. And in late 2025 commentary, the deficit framing didn't disappear. It intensified because supply is constrained and investment demand is waking up again. So the core point is simple. Platinum's balance sheet is tight. And in tight markets, price becomes a weapon. Why supply is the true choke point. Here's the part most people don't understand. Platinum supply is not diversified. It's not nicely spread across the globe. It's concentrated. South Africa is the giant. Over 70% of the world's platinum supply is tied to South African output. And this is where the risk lives. When one region dominates supply, the market becomes fragile. Because you don't need a global crisis to break the flow. You just need a localized disruption to shock the pipe. And even without dramatic disruptions, we've seen supply pressured by restructuring, investment constraints, and operational headwinds. Exactly the kinds of slow burn issues that shrink output over time. That's not a one-day headline event. That's a multi-year grind. And multi-year supply grinds create the most violent commodity moves because nobody panics until the shelves are already empty. Why don't they just mine more? This is the question people ask right before they get steamrolled. Why don't they just produce more? Because commodities don't work like an app. Mining is capital intensive, permitting takes time, projects take years, and producers don't expand unless price incentives are high enough and stable enough to justify it. Even industry leaders have warned that primary supply could shrink materially by decade's end without investment. So when demand rises into a constrained supply base, price doesn't gradually adjust. It gaps, it jumps, it overshoots. That's the nature of a thin market discovering scarcity. Demand, the invisible handcuffs. Now let's talk demand, because this is where platinum becomes terrifying. Platinum demand isn't driven by one thing. It's driven by multiple engines. Engine 1, auto catalysts, and the EV delay reality. Platinum is heavily used in catalytic converters, and the energy transition is not a straight line. Hybrids persist longer. Heavy-duty vehicles stay on the road. Emission standards tighten, and the all-EV tomorrow narrative keeps getting delayed and revised. This dynamic has been repeatedly cited as supportive for platinum group metals demand. And here's the kicker. Engine 2, palladium to platinum substitution. When palladium got expensive, automakers started substituting toward platinum where feasible. That substitution trend has been a major driver in platinum demand discussion. This matters because it creates a nasty feedback loop. Platinum tightens, platinum price rises. But automakers still need it to meet regulations, so demand doesn't drop quickly. Price rises again. That's how a metal starts acting like a trapped spring. Engine 3, industrial demand that doesn't negotiate platinum, is used in chemical processes, glass production, petroleum refining, and high-temperature industrial applications. These are not nice-to-have uses, they're operational inputs. Factories don't sell because RSI is high. Factories buy because the line stops if they don't. Engine 4, investment demand, the late stampede. Investment demand is the accelerant. Industrial demand is the slow burn. Investment demand is the gasoline. We've already seen the tone shift. Major coverage has described platinum's sharp gains and the renewed interest as uncertainty rises. And once investment demand returns to a tight market, the move gets violent because investors don't buy ounces, they buy stories. And platinum's story is simple. Small market, tight supply, structural pressure. That's all you need for a stampede. Now let's address the angle you asked for. Silver is overcrowded. Platinum is quieter. And in markets, quiet doesn't mean weak. Quiet often means underpositioned. When a trade is underpositioned, it has more upside air, less overhead supply from trapped bag holders, fewer people looking to sell the pop, less leverage shaking out the move. Platinum can rise simply because it's not jammed with tourists, and we have a real-time signal of that. Platinum has been surging hard. December 2025 saw an explosive monthly move, with catalysts like policy shifts and supply constraints highlighted in mainstream coverage. That's not quiet anymore, that's awakening. The geopolitical spark, why tensions amplify thin markets. Now let's talk geopolitics, because this is where people get misled. Is Venezuela a platinum producer? No. That's not the claim. The claim is something more important. When geopolitical shocks hit, especially ones involving shipping lanes, sanctions, energy security, and risk sentiment, capital starts looking for strategic assets. And right now, markets are already in a geopolitical stress environment, with Venezuela turmoil appearing in major market coverage alongside broad precious metal strength. In that environment, investors don't just buy gold, they buy the next gold, they buy scarcity, they buy strategic inputs. And platinum fits that template perfectly. It's scarce, it's industrially essential, it's supply concentrated, and it's already in a tight balance. So geopolitical stress doesn't have to affect platinum supply directly to matter. It affects risk premiums, insurance costs, currency moves, safe haven demand, and the psychology of hoarding real assets. And psychology is what turns a grind into a spike. The true mechanism of going vertical. Let me explain what vertical actually means in commodities. It doesn't mean people suddenly love platinum. It means the market can't clear at the old price. So it clears at a higher one, and then a higher one, and then a higher one, until something breaks. There are only 3 ways a commodity squeeze resolves. Demand is destroyed, people stop using it. Supply ramps up, new production arrives. Inventories are liquidated, hidden stockpiles hit the market, and platinum is tricky because demand is partly non-negotiable. Supply is slow to ramp, inventories have been getting drawn down, so the easy escape valves aren't easy. That's why platinum moves can be sharp. The palladium memory. If you've been around commodities long enough, you remember palladium's surge years ago, driven by persistent deficits and auto demand, pushing prices to extreme levels. I'm not saying platinum is a copy-paste. Markets never copy-paste perfectly. But I am saying the mechanism rhymes. Tight market industrial dependence, slow supply response investment chasing, price overshoot. That's the recipe. And the reason I'm focused on platinum now is because the ingredients are already on the table. Okay, but why now? The 2026 timing window. Because timing isn't just fundamentals. Timing is when attention rotates, and attention rotates when a crowded trade hits resistance, silver churns and frustrates everyone. A quieter trade starts trending, platinum breaks out and gets airtime, headlines validate the move, Mainstream coverage frames it as supply plus policy plus uncertainty. We are in that window. Platinum has already cleared psychological barriers by moving back above levels not seen since the 2008 era, with mainstream market outlets noting the significance of these levels. And once a metal gets that historic breakout label, you attract an entire new category of buyer: trend followers, macro funds, momentum, algos, and the general public. That's when the slope changes. The real bull case: deficit plus policy plus strategic metals era. Now let's put the bull case into one coherent chain. Supply is constrained and concentrated, South Africa dominance. Deficits have been chewing through inventories. Reuters, auto demand remains durable longer than expected, and substitution supports platinum. Reuters, policy and uncertainty are pulling capital toward strategic inputs. A thinner market responds with volatility. That's the chain. And here's the most important part. This is not a one catalyst market. This is a multiple pressure fronts market. Those are the markets that surprise people. What would invalidate this thesis? Let's be adults. Every thesis needs an invalidation framework. The platinum bull case gets weaker if global growth collapses into a deep industrial recession that crushes auto and industrial demand. Recycling floods the market unexpectedly. Producers ramp output faster than expected, or substitution goes the other way. Platinum gets too expensive and demand shifts away. But notice something. Even when demand dips cyclically, the supply side doesn't magically heal overnight, especially when investment in new production is constrained. That's why tight commodities tend to recover violently after downturns, because the system doesn't rebuild capacity quickly. How do I not get played? The battle plan. Now we get practical. You don't survive commodities by being right, you survive by not getting shaken out. Here's the battle plan. 1. Stop watching platinum like a stocks or sentiment machines. Commodities are inventory machines. Your key questions are: is the deficit narrative strengthening? Are inventories tightening? Is supply still constrained? 2. Respect volatility. Platinum doesn't glide, it snaps. You have to emotionally budget for that. If you can't handle a 5% day, you don't deserve a 50% year. 3. Watch macro triggers. A stronger dollar can pressure metals short term. Rate cut expectations can support them. Geopolitical risk can light them up. 4. Understand the crowd rotation signal. When silver sentiment is maxed out and platinum starts stealing headlines, that's rotation. That's when the quiet metal stops being quiet. 5. Have rules, not feelings. If you're an investor, you scale, you don't YOLO. If you're a trader, you define levels, size small, and respect stops. No hero trades. Hero trades get buried. What does vertical look like? Here's the pattern you're looking for. Platinum chops higher, frustrating everyone. It breaks a major level, pulls in momentum. Pullback gets bought instantly. No follow-through selling. Headlines shift from platinum rises to platinum shortage. Then you get the phase where the chart stops looking like a staircase and starts looking like a wall. That wall phase is when supply is not meeting demand at any reasonable price. And you don't want to be discovering the story after the wall starts. You want to be positioned before the slope changes. Let me be clear. I'm not anti-silver. I'm anti-crowd. Silver can still win. Silver can still squeeze. Silver can still do insane things. But the question is, where is the most asymmetric move from here? And right now, platinum has a unique setup, already ripping. Already in a constrained supply narrative, already pulling attention, and still not the default metal for the average retail buyer. That's the sweet spot. Because once the average buyer arrives, the discount is gone.